Hi, I'm Paul Seabridge, CEO of Kleinsman Global LLC. I run a mergers and acquisitions firm, and I'm working in partnership with James and Gary to build a game changer for the construction sector. So before I share with you exactly what we're doing, let me give you a very quick introduction to me and how I came into doing what I'm doing and why we're building this. So I built a global recruitment business which I sold in 2010, and since then I've been involved in buying and selling businesses, investing in them, merging them. And I guess when I was building my recruitment business, it took 7 years to get the business to a 45 million turnover. But it was a pretty tough journey along the way. And whilst we got there in the end, I ended up, as part of building the business, giving away about half of the business to private equity firms to access the capital to be able to grow. And I guess the challenge for small and medium enterprises, just as it was for me back then, is that when you actually have a successful business, and it's pretty tough to get there in the first place. I think 94% of startups in the UK fail within the first 5 years. So actually, when you do make it, if of course you do make it, it's pretty tough then to gain access to the capital to be able to grow and scale your business. You can go to the bank, but you probably have to sign away your life, your personal assets, your house, and put all those things up as security to raise the finance, and that's assuming that the bank will lend to you in the first place. Or you can potentially go down the private equity route, where you'll give a fairly meaningful chunk of your business away in return for some capital investment. So private equity is quite expensive. So I guess what we're doing and what we're building is really built out of those sort of frustrations. So the agglomeration model was really sort of born out of all of that. So one of my really good business partners actually invented the agglomeration model, and we'll be working with him in actually building this model. So let me share with you now exactly what it is that we're doing and how we're doing it and what that could mean for your business, and see really, I guess, the ball's in your court to explore whether or not you feel this is something that's going to be right for your business. So what we're doing is we're looking to put together a group of companies to form a larger group, and it's the larger group that we would then float on one of the capital markets. Now, if you add up the balance sheets and profit and loss accounts of these proposed companies that we'll group together, as a collective, we will have probably a market capitalization, so a value of 50 million, revenues of somewhere between 25 and 30 million, and EBIT, so earnings before interest and tax, or for the want of a better word, profit, of somewhere in the region of about 5 to 6 million. And the idea is it's that larger group that we would float on one of the capital markets, and it's the funds that we would raise then from those capital markets that would be used by these group of companies to basically make yourself bigger and better than you are today. And when I say making yourself bigger and better than you are today, principally the sums that we raise from the capital markets can be used to grow your business significantly. So that could be by organic growth, that could be by investing in new projects, but principally it will be about investing or buying, acquiring your competitors or related businesses. So acquisitions can be horizontal, so basically you buy a business that does exactly the same as what you do, a competitor, or it could be a vertical, so it could be a slightly different offering than what you offer, but could obviously add significant value if you were able to acquire them. So the financial model is we're looking to raise, we're looking to float the business for an initial market capitalization of 50 million. 75% of the shares of the business will be owned by us for putting it together, you and the other businesses that would take part in this. So the company, the group company that we float, the PLC, will be majority owned by the founding businesses, so 75% of those shares. The other 25% is what we're, if you like, giving away, offering to the markets. So we're giving away 25% of the company in return for 12.5 million. So that's what we will initially raise from the capital markets. In terms of the share model for you, we don't know what the value of the shares will be to your business without looking at the financials of your company, but as a rule of thumb, it will be a multiple of your EBITDA over the last 3 years, and if you own any meaningful assets, then they will be taken into consideration to produce the value. Now, the actual group itself As I've said, the combined P&L and balance sheet will look somewhere in the region of about 25 million, 30 million revenue and EBIT of about 5. Now, we would look to float the business for somewhere in the region of 8 to 10 times EBIT. So that's where we get the 50 million market cap for. 25% of that is 12.5 million. So that 25% that we sell to the capital markets is where we raise the 12.5 million from. So those shares are going to be bought by City investors, City institutions. And then it's that 12.5 million that we'll then use to make ourselves bigger and better. Now, the reason that we're really interested in the whole construction space is that it's a really fragmented market. It's clearly very tough for small businesses right now. We've got the impact potentially of Brexit that's affecting the market. We've got a changing economy, and we've just got the all the other things as well that happen in industry. So there's obviously more technology being introduced, and all of these things make it pretty tough for small businesses. So if it's a business like yours that's really well run and profitable, great, but there are clearly a lot of operators out there. As I said before, 94% of small business startups fail within the first 5 years. So there's a lot of operators out there that are struggling. Now, that gives us a real great opportunity to go and acquire those sorts of businesses, or businesses that have potentially lost their way, that we can bring into the group, fix them and turn them into something much more valuable. Now, in terms of driving the value of the group, we believe the fact that we're actually only offering a small amount of shares, so we're only offering 25% of the company for sale to the markets. So there's actually in the first place not many shares available to buy. We believe also, because we're going to be floating the business at a fairly competitive level in comparison to other construction related businesses that are already listed, typically they'll be valued at anywhere between 15, 25, even sometimes 30 times their earnings. We'd be looking to list this business for somewhere in the region of 8 to 10 times, so a really competitive share price to start with. So the fact that there's not many shares available and they're pretty cheap to buy in comparison to other construction related businesses, we believe will generate a rise in the share price. And like everything, there's never any guarantees, but we believe that because of those things, then initially there is a reason why the share price could rise. The other fundamental reason why we think the value will be enhanced is because we're raising the money, and we're not using that money to spend it on bells and whistles. We're using that principally to go out and make acquisitions of either horizontal, so our competitors, or vertical, so related businesses. And so every time we make an acquisition and we spend that 12.5 million, when we bring a new company into the group, our revenue will grow, our profit will grow, and our balance sheet assets will grow. And clearly, from an investor's point of view, that's very attractive, because every time we make an acquisition, our revenues are going up, our profits are going up, our assets, our value is all increasing, which we believe will have a very positive impact on the share price. So whilst this is potentially ultimately creating an exit strategy for all those concerned, there are a number of other benefits as well. So let me talk about some of those other benefits. So that's our model. Let me just outline a few other things, because I guess that when most companies float and become public, they're typically offering a big chunk of their shares to the market. So in most listings, you're looking at 75 to 90% of the shares being issued to the markets. So you're fundamentally, in that sort of model, at the beck and call of the city, the institutions, the investors that are the main shareholders. What's different about our model is that 75% of the business is owned by us and you and the other businesses that take part in this. So fundamentally, we're the people that make the rules. We're the people that set the strategy. Only 25% of the company will be owned by city institutions and investors. So I guess our model differs quite differently to other listings that are happening. I think that also means that in terms of control, what we're not looking to do is create a PLC that becomes the main focus for everybody. Fundamentally, the PLC company, it really doesn't matter what we call that business, because it's purely a vehicle for listing this company on the markets. What you call yourself and trade as today is fundamentally what you'll be known for. But if you ever need to point to the PLC, for example, for the contracts or tender purposes, then you can do so. But it's not as relevant as what your business, your brand is today. So all of the decisions that you make today, such as what you call yourself, who you trade with, who you employ, how you market yourself, right the way down to controlling your bank account, all of those decisions that you currently control today will continue to be in your control. So that won't change. It's just that you will be owned by a PLC rather than you owning your own company, and it's you that will have a share in that larger entity, that PLC, that will be floating on the markets. So just going back to control, one of the things that we don't want to happen is for you to get too distracted in having to run a public company. So on the day that we float, we'll be appointing a group board. And when I say we, I mean you will be involved in that process. So the group board will consist of a non-executive chairman who will be ultimately the face of the company, the person that manages the relationships between our shareholders and the board. There'll be a group CEO that'll be responsible fundamentally for strategy. Now, because most of the businesses that we take into this probably haven't made acquisitions before, I guess a big part of the CEO's role will be to support that process. So it's all well and good spending that 12.5 million to go and buy other businesses, but that's only half the battle. We want to make sure that we're buying the right businesses, that we're protecting ourselves, that we're structuring the deals in the right way, that we're not being ripped off and we're paying a fair price. And I guess the CEO will be working with the managing directors of these businesses that take part to help in that process to make sure that those acquisitions are made appropriately. And there'll then be a CFO, Chief Financial Person, that will be responsible for running the public finances of the company and complying with all the fiduciary duties and all of the reporting requirements and stock exchange rules and regulations that we need to be mindful of when running a public company. So they will sit on the group board. When I say we, as I've said, we means me, you, other businesses who will make those appointments, and the board will ultimately be responsible to us because we are the majority shareholders of the business, owning 75%. Now, you would then sit on a management committee underneath the board, and that management committee will consist of all of the founding business owners, shareholders, directors, and fundamentally that management committee controls the company because that management committee is there to set the rules, set the agenda, set the strategy. So whilst the strategy on day one is to go out and spend the capital on buying other businesses and making ourselves bigger and better, fundamentally as a collective committee, we can control that strategy and change it should we wish to do so. So the day-to-day control, making the rules, still stays in your control, and you're going to be working with other like-minded, very successful businesses to turn ourselves into a much bigger force in the marketplace. So in terms of timescales, our goals around timescales are that we would like to select the right businesses that we want to bring into the group and be in a position, if not at the end of quarter 3, at the early part of quarter 4 of this year, 2018, and we want to pull those businesses together. So we want those initial 6 or 7 businesses together to form that larger group. We'll then look to prepare the IPO. So we can't prepare the IPO until we actually have the group formed. So for this period, the group will sit as a group private entity, but we will be building the IPO during that period, and we'll be looking to get the business listed in the early part of next year, 2019. So typically there is a somewhere between 90 and 120 day window for us to prepare that IPO. And fundamentally, the things that we need to do to prepare that IPO is that we need to produce a group set of accounts, we need to have audit, we need to have all the due diligence information available to the city regulators, etc. But really the main part of it is to actually go out and do the roadshows and sell this model to city investors, city institutions, so that when we actually come to the day of the listing, we've already got the shares subscribed. We'll be looking to float the business at some point in the early part of 2019. So there we have it. That's a very quick summary of our model, what we're building, why we're building it, what it potentially might look like. If you'd like some further information, you can visit the website www.kgllc.org, where the model is outlined in more detail. If you'd like to reach out and learn more, then please connect with me. You can contact me at my email, paul@paulseabridge.com, and I'll gladly answer any further questions that you might have about this.